Hello, everyone. Welcome to Sticks and Bricks, a podcast that takes you behind the scenes of luxury custom home building. With me, Sherwin Loudermilk, your host and president of Loudermilk Custom Homes, where we believe in the mantra, build it like it's yours. Have you ever wondered what goes into creating a custom dream home? Well, you're in the right place. In each episode, we'll dive deep into building science processes and construction business practices through interviewing leaders in the industry. We'll discuss the world of home design and construction by sharing stories, insights, and the secrets that make Loudermilk Homes the leader in Georgia and Western North Carolina. And here's something special for you. Stay tuned at the end of each episode for our Builder Pro Tips segment. We'll provide actual items and insights for you to use on your own projects, so you can turn inspiration into action. At Sticks and Bricks, we want to make your journey into luxury custom home building both informative and practical. So buckle up, get ready for a fascinating ride through the world of custom luxury home design and construction. Let's build something extraordinary together. Welcome to Sticks and Bricks. Welcome, everybody, to the next episode of Sticks and Bricks. I'll be your host, Sherwin Loudermilk. I'm with Loudermilk Custom Homes. We're a high-end luxury custom home builder out of both Atlanta, Georgia, and also the mountains of Highlands and Cashiers, North Carolina. I'm really excited for this show. We are hosting Chad Wade with Cornerstone Mortgage. Chad, welcome to the show.
Hey, thank you so much for having me.
Yeah, I'm really excited. So what we're going to be talking today about is the market and finance and lending and all of those things. Chad's one of the leaders in the industry in mortgage and understanding what's happening there. But before we get into that, I wanted to tell the audience our background and history. We've been friends for, almost 20 years now. We were friends of friends and then ended up on the same tennis team. Ended up playing doubles together a fair amount of time and actually won a fair amount of our matches. So that was a lot of fun. But even what's more near and dear to my heart is that we both built our businesses together at the same time and really supported each other in a lot of what we did, not just through conversation, but actually through action. I remember earlier in my career when we had to get loans for people that they couldn't get a loan. I always reached out to you, Chad, and you said, let me figure it out, whether it was an appraisal issue or whatever the issue was. You were able to sprinkle your Chad fairy dust on it and make it work. So cannot thank you enough for helping me build my business up throughout all the years.
I couldn't agree more. We've also, by the way, done a lot of like professional development stuff, right? We've sat in some cool classes together, learning, sharpening the saw together. And so we've come side by side doing that too, which frankly, I think that's awesome as well.
Yeah, one of my favorites is when you invited me to the One Thing seminar based on the One Thing book by Keller Williams. And that was just phenomenal to really focus yourselves on what's the most important one thing you should do for the day. Yep. So it was great. Well, Chad, tell me a little bit about yourself and then tell me about Cornerstone Mortgage and why you started it.
Yeah, so Chad Wade, I'm one of the two partners of Cornerstone Mortgage Group, married, 3 kids. Couldn't tell you about me without mentioning my family. Everything I do really is frankly, intentionally designed to create better and thriving lives for me and for them, right? And so Cornerstone Mortgage Group is part of that whole plan. And it's not just my family, it's my circle and the people who I have influence on. I frankly just want to try to leave the world a better place. That's my goal. And so, Cornerstone developed from my desire to, I've always enjoyed numbers, but I also want to be able to help people and add value. And so the way that I like numbers and the way that I'm able to work numbers and what numbers work real well for me, that tied with kind of the real estate piece of helping clients buying houses, it's just the perfect fit. And so Cornerstone came from that. I didn't want to be a real estate agent. There wasn't enough numbers in that for me, but I did want to help people buy in real estate. And so just a natural fit. I've got a degree in risk management. I thought I was going to be an insurance guy. Interestingly enough, I wanted to insure skyscrapers and stadiums and things like that. And I learned very quickly at 22 and 23 years old that comptrollers and CFOs of major corporations don't take you serious. And so I decided that maybe people buying a house would. And as fortune has it, it worked out for me.
Now, Cornerstone Mortgage, you're not a bank, right? You're a broker. Can you tell people what differentiates you from a bank?
Yeah, so it's interesting in the space of mortgages. You've got tons of different companies, right? You've got brokers, you've got something we would call correspondent lenders, then you've got banks, you've got a conglomerate of different places. But at the end of the spectrum, for 80% of the loans that are out in the marketplace, you've got 2 big buyers, Fannie Mae and Freddie Mac. These 2 big conglomerates, Fannie Mae and Freddie Mac, you could be a bank, you could be a correspondent lender, or you could be a broker. but they are buying them on the back end. And so when one talks about a conforming mortgage, that's a word that gets thrown around a lot. All it means is it conforms to the guidelines of Fannie Mae and Freddie Mac. And so we actually operate as a correspondent lender. That's the way our license is within the state of Georgia. So we're a lender here, and yet we broker a lot of the business we do just because it offers us the ability to get clients better terms in a lot of situations. So on a case-by-case basis, depending upon what's going to put any said client in the best position, we operate through that medium. That's the cliff notes.
So you're able to look at so you have multiple lending entities that you work with, and then based on the circumstances of the client, you might know that a certain bank is better to go to versus another bank. How would that work?
That's exactly right. In the space in the world that I live, conforming mortgages mainly. Now, again, we do FHA, VA, some USDA. There's jumbo loans too, but the lion's share of what we do is conforming. You've got these guidelines that are very static, and anybody could access them. There's things called seller guides on the internet that actually tell you all the guidelines for conforming loans. However, different lenders and different people in the marketplace will interpret certain guidelines differently. And so on a case-by-case basis, even though the guidelines are the same, we may take it to one place versus another that we understand interprets those guidelines differently, right? And so it's an experience thing. The other piece of what we do is we chase price. We chase the best interest rate in the marketplace. We lead with that. We learned a long time ago that the number one thing that people want is good terms, right? They also want really good service, and they want to make sure that they're going to close on time and everything works. But the first question is always, what's your rate? Regardless of what we've done over 20 years in the white glove service and all that, the first question is always, what's your rate? And so we own that as well. And so we'll chase different investors, to your point, for the best price in the market. But then we marry that together with who is going to make it easiest for us to close this as well.
No, I love that. All of the clients that you've helped out with and my friends that I've turned on to you, they all say that you were able to find the better rate, and it's because you have multiple different sources to come to, right? And
Yeah.
more importantly, you know the thresholds of what each of those lending sources likes and what they don't like. And so you can put together a very customized, curated environment for your client to get the best deal. That's fantastic. So a lot of clients feel like, we hear this in the marketplace that, hey, my lender isn't really listening to me. They're not hearing what I need. What kind of things do you do to try to better understand your client's desires and needs?
Yeah, I mean, everything leads with motivation, right? Every client's different. We start with price always because, frankly, we've just learned even though that's not the most important thing to most clients, it's always the first question. But the second question is like, what's our motivation? Like, what are we worried about? What do we want? A lot of times when it comes to that type of stuff, people want to just know that they're going to be able to get under contract. They're going to be able to afford the house they have. And so we've built a process out, just like most companies do as you scale, to where we've got milestones. We're going through things. We're making sure numbers are clear. We're making sure we understand what the budget looks like. We're understanding what type of house they're looking at specifically. Is this the type of house that's probably going to have multiple offers? So we need to be able to put them in a better position when it comes to making that offer with maybe a stronger pre-approval. Do we need to call behind their offer as the lender, right? So even though their agent's making an offer, most agents, when they get an offer, if you're a listing agent, it's not normal to get a call from the lender representing the buyer talking about how great and how creditworthy they are. So there's just all these little nuances, right? What we do is it's simple, but it's not easy. That's the best way I could put it.
Yeah, it's very customized and tailored. I love it.
That's exactly right. Yep.
Well, let's talk about the rates, right? The Fed has raised the rate. We're in a weird place in time and history where the Fed has raised the rate because the market is doing too well, right? And then at the same time, supply chain issues have made through COVID, or the results of COVID, I should say, have made prices go up significantly. So now you not only have more expensive product out there, but you also have higher rates. But here's what's crazy. We still have a lack of supply. And so it's creating this weird situation. So let's talk about that a little bit and nerd out. Let's geek out on this thing. Why do you feel the interest rates are so high right now?
So let me start with, I've been doing this 20 years, and I think I have a really good understanding of this. And yet you could listen to 4 different people talk about it, and you'll get 4 different explanations. And I recognize that, and I acknowledge that. And I think mine has a lot of weight to it, but I'm not willing to own that it's exactly right. So start with that. Now that groundwork is laid, I'm going to tell you what I really think. I think during COVID, our government did everything it could to make sure our economy was stimulated. And they put a lot of money into the marketplace. Some people, if you read articles, say that 40% more money was added to the marketplace versus pre-COVID. So people use the metaphor of helicopter dropping dollars into the marketplace. And it's so people continue to spend. We wanted people to continue to spend during COVID because we didn't need the economy stalling out during that period. Unfortunately, as they did that, a lot of people started putting cash away, right? So they spent a little bit, but they actually saved a little bit too. In addition to that, once people got more comfortable with how much money they have saved, it put people in a position to maybe buy things they wouldn't have bought before. And what happens is as you increase demand for things, and it could be automobiles. We saw this in the used auto market. It could be pools. You just go down a list of luxury items. As more people start buying more luxury items, the demand goes up. As demand for anything goes up, generally, if supply is static, then price increases. So we saw inflation, and it became pretty rampant. At this point, I think everybody understands inflation got rampant through the COVID period. And my theory behind that is just all the extra dollars in the marketplace for no other reason other than supply chain issues and too many dollars in the marketplace. Now, as we've moved forward, what we've seen is we've seen the inflation that we needed to get under control, and the Fed started raising rates to get it under control. It's pulled back, but it's still not at the levels that the Fed sees fit for a stable, healthy economy. Like in a perfect
When you
world.
say levels, you mean the levels of inflation, the percentage of inflation
Right.
the market is pushing each year.
Yeah, ideally, so a healthy economy has inflation somewhere in the 2% range, right? So the whole thing is built off everything becoming slightly more expensive every year to the tune of about 2%. Whenever we see 6 and 7 and 8, I think we might have had 9, if memory serves me right, percent inflation year over year, that's not good. Things are getting way too expensive, way too fast. Wages can't keep up. The whole thing breaks pretty quick. So the Fed has to take corrective action, which is let's make money more expensive. That way people don't want to spend money because it's so expensive. And the opposite of expensive is we'll pay you more on your savings account, right? So a lot of people these days right now are getting like 5% on a savings account, which, 5 years ago, that was unheard of. You're getting 0% on a savings account. So we're doing this thing Fed-wise, trying to retract the economy. We're trying to slow the spending because if we decrease demand, well, then assuming supply is stable, then price should go down. It's just not happening as quick as we want, though. When they look at things like CPI, Consumer Price Index, which is a measure of inflation in the marketplace, it's still staying higher than targets. And as long as Consumer Price Index stays higher than targets, along with employment continuing to stay stable, which it has. I mean, we've got really low unemployment still. You have to then understand the Fed has two jobs: keep inflation under control and keep people employed. If inflation's high and everybody's still employed, the only thing they can do is either raise rates or keep rates where they are. So at this point, they've raised them. Inflation's still high. So their only choice is really to leave rates where they are until inflation gets under control or we run into an employment issue, right? So if all of a sudden inflation stays high, but then people start losing jobs, well, now the Fed has to choose what's more important, getting inflation under control or helping money move so we get more people employed. We're not in that place yet, though. We're in a place with stable employment and high inflation still. So the only answer is keep rates high. And
Right.
I don't like that answer, by the way, because I run a mortgage company.
Right. It's directly impacting your business, right?
Yeah.
So it's interesting to see that the government is essentially, the market is doing so well right now that the government is saying, we need to pump the brakes on how good it's doing. Isn't that strange that, a lot of people are saying we might be going into a recession, but the market is doing so well right now, but it's the inflation hurting us more than anything else.
It is. And we're in the mortgage business, and we talked about this beforehand, but we are in a recession in the mortgage business, right? And it's because of the high rates. But if you look at the equity marketplace, like the S&P 500 is at an all-time high right now, right?
Mm-hmm.
And so, I mean, you can call that inflation, you can call that a booming kind of economy, call it what you want, but it's at an all-time high. And so there are a lot of marketplaces, there's things like employment, all these things point to we're actually doing a lot better than we think. And so, what I believe is I think a lot of people believe a recession is coming, which the answer is it is. You have bear markets and you have bull markets. It's like seasons. It just as likely as we have summer, winter, spring, and fall, we're going to have these seasons in real estate and economically where things go up and things go down. It's part of the natural cycle. So there is a recession coming. There's always a recession coming, as long as a bull market, in addition to a bull market, a good market. I think people just feel like it should have been here sooner. And so they put that language on it. But when you look at metrics, if we take the language out and take what we believe out, and we just look at CPI, so the measure of inflation, and we look at employment, and we look at things like the equity marketplace, stocks, and the price of stocks, we're booming. We're not in a recession. I mean, that's just the reality.
Yeah, different markets might be suffering in different ways. Like we were talking about before, that 2008, 2009, home builders were really struggling because there was no demand and there was an incredible amount of supply. But lending institutions were doing okay, not great, but doing okay because you had a lot of government programs to support that lending.
Yeah, that's exactly right. And it's interesting, in the past, and this is just my soapbox in the mortgage business, the government, a lot of times they'll stimulate the economy when everything's slowed down. They figured out that they can stimulate the economy by lowering mortgage rates, because if they can save people money on a mortgage, it frees up money in a budget for a family. And if you can free up money in a budget for a family, they'll go spend it in other places. Maybe they buy more groceries, or they discretionary income, do these things. They've done that a lot in the past, like 2008, 9, they did that. 9/11, they did that. Anytime there's a crisis and the government's worried about people kind of tightening up, generally that's what happens. Right now, it's the opposite though, right? People are actually spending more than they should, frankly, still, when we start looking at inflation and these other things. And so what we're experiencing right now in the mortgage business is the opposite. The government's like, no, we can't help you right now. If we lower rates, it's just going to increase discretionary income in households even more. And that's just going to put even more upward pressure on inflation, because people are then going to have even more money to drive prices up. We hear you, Chad, and no, we're sorry. It's not time to lower rates yet.
Fascinating economics. So crystal ball, do you think that interest rates are going to go back up? Do you think they're going to come back down? If so, when?
So my prediction is they come back down. I don't think it happens until next year. And I don't know why I keep saying that, other than it's just a gut, just looking at the way things are moving. They will come back down. Again, this is a cycle, and we go through cycles all the time. And so they're going to go back up, and again, at some point, they're going to come back down. And imagine a wave, right? It's like asking, what's a wave going to do? It's going to go up and it's going to go down. It's going to do what waves do.
Right.
And so economically, we're going to see it. We're going to see things happen the way they generally happen. The timing is really where everybody wants answers around. I think with the election coming up, even though elections aren't supposed to impact things like rate policy, I think that maybe you see things start to trickle down a hair. But honestly, I think it would be too soon, frankly, to see rates go down right before the election, just because we've still got booming reports as of a week ago, and the election's coming up towards the end of this year. But more realistically, if we were going to move into a recessionary market, I would say next spring is when you start to see it. And then that's when the Fed starts to do the things that they're going to do. And if it doesn't happen next spring, then, fast forward to next fall, because that next winter season would be the next big moment, because generally things slow down. Our economy, and especially real estate, it operates off a bell-shaped curve when you're talking about home sales and mortgages and anything in our space. Now, some retail stuff's different because you've got winter and the holiday seasons where things go up. But when you're looking at things like what me and you do, winter time. So it's either spring or winter where things are really become very clear. We'll just put it that way.
Okay, fantastic. So let's say a client is looking and saying, okay, in 6 months, 9 months, I want to buy a house. What is your recommendation for that client to do? What should they do? On how should they focus on their credit? How should they get prepared for a loan if they're thinking in 6 to 9 months they're going to get one?
I would do two things. I would have them talk to somebody that they trust, right? And so if they were going to buy a home from you, or if you knew an agent they were going to work with, I would have them reach out to that person that they know, that they trust, and say, hey, do you know anyone who you trust to help me just make sure that I've got all my ducks in a row, right? If they don't know anybody and they see this video, call me, right? But get with somebody that you can trust that'll just look at your scenario. And it's not that they might not qualify, but is there a way in which they could change certain things that might put them in a better position to get a better mortgage when it's time, right? And, I can't tell you how many people call me and tell me they have perfect credit. They don't want to really run through the process until they find the house. I advise against that. And then they go under contract and they call me and they say, hey, I'm ready to go. And I pull their credit. Instead of having the 800 score they thought they were going to have, they got like a 680. And it's because they thought they paid off their Capital One account 9 months ago, but the amount they sent in didn't cover the last couple of days interest. And there was an $8 balance that's just been going unpaid. And now they're 90 days late on a Capital One over $9, and their credit score dropped 100 points. and I don't find out and can't counsel them until they're already under contract. And generally the way that plays out is we figure out a way to sprinkle my magic chat fairy dust that you talked about on the deal, but they still end up taking worse terms than they would have if we would have gotten ahead of it. Right. So it's just little things like that. What I would recommend is just get somebody you trust just to put their eyes on the whole scenario, make sure everything is as it should be. And then assuming it is good, you're in a good place. Now, the other thing I would caution people on, though, I think once rates come down because of the supply issues that we've run into, and frankly, because of the impact of investors in our marketplace, I think supply is actually going to get even worse once we have lower rates, right? So even right now, even though things have slowed down, rates are really high, we only have 3 months of supply in the metro Atlanta area. So if you're looking at the Atlanta metropolitan marketplace, we're at 3 months supply. A balanced market is 6 months. We're still half away from a balanced market. If you lower rates and make homes more affordable, there's so many people that have just been waiting to buy and sell because the rates were too high. And so that same person, I would also say, hey, it may be worth considering seeing if you could buy now. And they're going to say, I don't want to, rates are too high. And I'm going to say, okay, but if you wait until rates go down, you're going to have to get in line with everybody else that wants to buy. And by the way, when a lot of people want to buy, it puts upward price pressure on home prices, right? And then you get into a bidding war, and nobody wants to be in a bidding war. You know what I mean? And as they should not want to be.
Yeah, interesting. As a home builder, you were talking about months on the market. I look for anything below 5 or 6 months on the market. And if that's the case, I'll go into that market because that's a great market. At 3 months on the market, that's insane, right? So that's something that would be very open. So there is still a high demand, but people can't afford it or are not willing to afford it right now because the rates are high. So there's this little bit of a stagnation that we see.
Well said. Yeah, very well said.
And also your Capital One example was near and dear to my heart because my daughter used my credit card once, my personal Capital One card that I never used just for a rainy day. And she bought a streaming service for, I can't remember, I think it was like $9 a month. And I didn't know about it. So 3 months goes by. I had my old email address connected to it because I never use it. And then all of a sudden I see my credit collapse over something insignificant. And so it took me 6 months to build back up to get above that 800 mark. And I'm sitting there going, I just lost 150 points because of a $9 charge a few months in a row. So it is really important for clients to check their credit on a regular basis. I know it's a lot easier today to check credit than it was 10 years ago. Most of the agencies out there like Capital One and American Express, I know Chase does it. I'm sure many of the other big banks do it as well. They give you free services to be able to at least check one of your agencies. I know there are 3 agencies, but at least one. But at least with that one, you can check to see what's happening on a regular basis.
No, I agree. Your story is, I'm not going to say once a month, but probably not much less than that. I hear it. I mean, this happens all the time. Everybody thinks they have an 800 score until the 1 out of 5 I pull. And it's like, you don't. Did you know you missed your Chase or your Capital One? And I didn't know that.
Right? Very innocent things that can hurt you in the long run and can cost you tens of thousands of dollars in the long run if your percentage is higher, where you don't really feel it every month, but it adds up through time just because of a little issue.
Yeah, it does. I'll share this with you. I do everything I can to get the best terms for all of our clients. And when I say best terms, I mean the lowest closing cost and the lowest interest rate. I've identified that the marketplace wants that. It's what it's fixated on. Whenever people don't know a better question to ask, generally they're just going to fixate on terms and price, right? And so I honor that. It's the easiest path for me as the owner of a mortgage company. On the flip side, an 1/8 of a difference or a 1/4% difference in interest rate, it's not the end of the world. When you look at the average like shelf life of a mortgage, it's somewhere around 5 years. So every 5 years, people are either selling or they're refinancing a mortgage on average. But when we math out a mortgage and the impact of a 1/4% rate, people always do 30 years, right? It's like my payment's $80 a month. And when I multiply 80 times 30 years, like this is going to cost me $40,000. Oh my gosh. And it's like, no, it's not. It's not. Like you're probably going to refi the next 3 to 5 years. Let's be honest. So, I mean, if we're really going to math it out that way, I don't know.
That's smart. That's smart for people to know because you're right. You can get into maybe not so great of an interest rate today, but then you're getting into an incredible one in 3 years when the market shifts.
And for a lot of our clients right now that are maybe choosing to buy now versus wait 9 months, right? Just because of the marketplace, we're looking at things like that, right? I'm saying, okay, let me show you what the terms look like today. And let's just hypothetically say rates drop to 5.5 a year from now. Let me run these same numbers at the 5.5% rate, just so you can see what things will look like whenever that next refinance opportunity comes up. And they're like, what if they go to 5, Chad? And so I'll run that scenario, right? Because it's just human nature to just kind of think bad, but the brain doesn't always go to the good place, but it's like, look at where this might be. We might, this not even might, logically, because a wave is going to do what a wave does. At some point, it probably will be this.
No, I had clients that didn't want to close on at 4% when the market was at 4% because they said, wait a minute, my buddy's just refinanced for 2.75 and it's at 4, I'm going to wait. And now they're looking at 7 to 8% interest rates. Speaking of, when I think of getting a loan, I'm thinking of two different things. One is down payment points, so principal points that you're paying down, and then also the overall rate. Can you talk a little bit about when should a client pay down more points, which is basically just giving money to the lender up front versus higher interest rates? Why should they do one versus the other?
Yeah, so there's, to your point, a point, right? So some places call it a discount point, some places will call it an origination point, but it's paying, for all intents and purposes, it's prepaid interest, right? We're paying money right now to get a lower interest rate on our mortgage. I'm not recommending, and I'll try to explain everything. So first things first, we can run math to figure out how this works, right? So if somebody's borrowing $500,000, we'll make it super simple, and they're going to pay a point. 1 point on $500,000 is 1% of 500,000, so it's $5,000. What we can do is we can look at the cost of that point, 5,000, and we can figure out how much does it reduce the rate. Let's just say it reduces the rate 0.25%, and 0.25% on $500,000. It's actually $1,250 if my math is right. And I believe it is 0.25, 500,000. I think it's $1,250. So what we can do is we can take that $1,250 that it's going to save us an interest expense roughly year over year. It's going to get a little less every year because the loan's amortizing. So the balance owed is paid down. But for this example, my math works. So if we save $1,250 year one, we're at $1,250. Year two, we're at $2,500. Year three, we're at $3,750. Year four, $5,000. So that equation I just did, it tells you there's a 4-year period to recoup the points that you paid up front in the monthly savings because of the interest savings. And we're doing this always whenever we're looking at scenarios where we're thinking about buying the interest rate down. Now, the other thing we're layering against that is do we think there's going to be a potential to refinance in the future? And if so, do we think it's soon or do we think it's far off? Well, right now, most people agree it's probably sooner versus later because we think the Fed at some point soon is going to have to lower these rates. Earlier, I was saying, I think it's going to be next spring. And so if next spring interest rates drop to that maybe the mid fives, like we talked about earlier, and you're refinancing out of this current mortgage that maybe you pay points on, and you got 0.25% lower than the average person gets because you paid $5,000, but you're jumping out of that mortgage next spring because rates are lower, you haven't been in there the 4 years needed to actually recoup those costs. It really didn't make a whole lot of sense. The long and the short of it is we need to be looking at all these things. We need to look at how much it's saving me on a monthly basis, how much it's costing me up front, what's the recoup period, and then what's the likelihood that maybe I refinance out before that period. With rates being as high as they are right now, Sherwin, I'm not recommending anybody pay points because most scenarios take at least 3 years to recoup. And most experts agree that we're going to see lower rates before then.
Yeah, we're actually telling the same thing to our clients. We're saying, listen, take the rates as they are right now. It stinks, but it is what it is. And then knowing that in the next 2-ish years, we don't know how long it's going to take, but 2-ish years, the market's going to have that bell curve effect and come back down, and you're gonna refinance, and it's not going to make any sense to pay down your points, pay down origination points to get your percentage down because you're going to be refinancing anyway. So
yeah, so it's great advice.
What else? Any other things in the industry or the market that you can share with our viewers?
What's happening a lot right now. I mean, we're seeing in my side, right? In your new construction, but I see some new construction, but I see a lot of existing resales too. Strangely enough, even though the number of sales are down, because inventory is down as well, and that's why we still only have these 3 months of inventory in the marketplace. I'm still seeing a ton of multiple offer scenarios. You wouldn't think that once you choose to buy a house, that it would be as difficult as it is to get the house that you want under contract. But strangely enough, it is. Like, people are having to pay close to list price. I think if you go to FMLS right now, it'll tell you most homes are selling somewhere around 97, 98% of list price. Assuming the house was priced right and it looks right, most homes that are priced right and look right are getting 2 to 3 offers. So you are having to compete with somebody else that just is the market. Those are really the surprising things. Like, when I talk to people and they figure out, like, what I'll do is I'll talk to them and I'll coach them through, hey, we're going to go ahead and get a super pre-approval for you. We're not only going to get all your information and pre-qualify you, I'm actually going to get your loan into underwriting beforehand, before you're even under contract, to get everything signed off on and approved early. When we go to the seller that you're going to make an offer on, we can tell them, or the builder for that matter, we can tell them that you're already through underwriting, everything's already done, and it makes your offer a lot stronger. Well, a lot of folks are like, I don't think I want to do that yet, Chad. I was just looking at houses on Zillow, and Sherwin told me I should call you to get my ducks in a row up front, but I might not buy it for 6 months. And to that same client, I say, well, here's the deal. As soon as you start walking new construction homes or looking at Zillow daily, I promise you there is a strong likelihood at some point in the next week to 30 days, you are going to find a house you like and you're going to make an offer. It's just the way things work. What you focus on expands. And it's just like if you buy a red car and all of a sudden all these red cars out there, if you're getting on Zillow and looking at homes all the time, you're going to want to buy a home. And so, that'd be the main thing, would just be tying back into what you said earlier, just getting your ducks in a row sooner. And frankly, even doing a better job than maybe what you thought, like finding somebody like me that's willing to go ahead and take your file all the way through underwriting, even if you don't think you're going to buy for 6 months, just so if you do happen to find that house on Zillow, or you walk that new construction house that you love, you can actually make an offer immediately, and you can make a strong offer. A seller and or builder would take very serious, because that's what you need in this marketplace, contrary to what people think.
Yeah, that's great advice. Well, hey, thank you so much for attending. For all you viewers out there, if you need a loan, I'm telling you, Chad is the guy to go to. He's with Cornerstone Mortgage. They're located in Alpharetta, right downtown Alpharetta. Please reach out to him if you're looking to either refinance or get a loan. Chad, thanks again for everything. Appreciate it.
Man, thank you. I really enjoyed this.
And that concludes another episode of Sticks and Bricks. I hope you enjoyed our journey into the world of custom luxury home design and construction. Before we say goodbye, let's dive into our Builder Pro Tips segment, where we've broken down today's episode into actual items. Remember, turning knowledge into action is the key to making your dream home a reality.
Welcome to the Builder Pro Tips segment. We just heard from Chad Wade with Cornerstone Mortgage about the rates and the Fed and how to help you get a loan. So our Builder Pro Tip is to start early. It's all about getting your credit score correct and having your paperwork ready to go, because you'll never know exactly when you need to pull the trigger when you find that beautiful lot or you find that beautiful house and you're ready to go. So make sure your credit is in line. Make sure that you have your documentation in line. You get a pre-approval ready to go, so that when that actual house comes up, you can grab it. Good luck, everyone.
I hope you found these tips valuable. If you have questions or want to share your experiences, please reach out. We're here to support you. Thank you for being part of Sticks and Bricks, and stay tuned for more inspiration. Make sure to subscribe below. Until next time, I'm Sherwin Loudermilk, signing off. Thank you for listening.